I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, economist John Williams at shadowstats.com. John Williams, thank you for joining us today from California.
Greg, it's my pleasure to be with you. Thanks for having me.
Well, we've had all this good news about GDP number and unemployment and all this stuff, and I wish you were here to tell us that that's all true and the economy is great and things are booming, but that's really not the case according to your reports. Tell us what's going on in the economy, really.
Well, I wish I could say things were booming, but indeed they're not. What's booming are the reports out of the GDP and some of the employment reporting. The GDP last 3 quarters, if you believe what they put out, it's the strongest 3 quarters of economic growth seen in more than a decade. That's not the common experience. It's not going to happen until you see the consumer recovering, and the consumer right now is in terrible liquidity straits. The employment numbers, they revised them higher in terms of jobs growth, payroll jobs growth. They added a new accelerator in there to make them grow a little more each month. But there are upside bias factors that are added into those numbers, order of magnitude 200,000 jobs a month. The reality is that the economy has not recovered. If you look at the official version of the U.S. economy, what you'll see is that the economy plunged through 2008 into 2009. Then the middle of 2009, it starts going higher again. It recovers. After 2011, it's expanding. New record growth. Everyone's happy. My contention is the economy plunged through 2008 into 2009, and then we entered a period of low-level stagnation. Some areas have gotten a little better, some areas a little worse, but we haven't had an economic recovery, and the economy is beginning to turn lower again. You see this in a number of harder statistics, not the heavily gimmicked ones, but for example, with retail sales, as reported just recently for the month of January, sales contracted month to month. That followed the fourth quarter, November, December, the traditional holiday season, the biggest part of the year for the retail sales industry. So worst Christmas shopping season since the economic collapse in 2008. January's off to an even worse start, and based on what we have now on January numbers, it looks like there's a good shot that the first quarter retail sales will contract relative to the fourth quarter, both before and after adjustment for inflation. And that's very bad. It's an early signal that you may have an outright contraction in the GDP, even as they reported in the first quarter. If you look at the employment numbers, yes, the news is happy in payroll employment, the one that gets all the press, is at a level that is above where it was before the recession started. But that's there's some funny things about that. First, in the payroll employment, that counts part-time jobs. It counts the jobs as opposed to the people. So that if you hold 3 part-time jobs because you can't get a full-time job, you get counted 3 times.
Yeah.
If you look out of the employment survey, the number of people with full-time jobs, those who want full-time jobs, the number of people with full-time jobs has yet to recover the level that you saw back in 2007 as the economy started to turn down. It hasn't happened. I mean, yes, the levels are higher, but they have yet to recover their pre-recession high. You look at durable goods orders that were reported at the end of December. That's a series that tends to lead industrial production. The industrial production used to be the GDP measure. We should go back in time when we had more of a production-based economy. But with sinking durable goods orders, and that's down fourth quarter over third quarter, you should see a period of decline here in industrial production. We'll be seeing reporting on that in the week ahead. That is That's likely to be weaker than expected. I think you'll see a quarterly contraction there. We've got retail sales, industrial production that's going to be weak. The housing numbers never recovered. They plunged and they've just been bottom bouncing. There's a major factor behind the economic collapse, and it still hasn't recovered. Any measure you look at is still well below where it was coming into the recession. And again, that's tied to the consumer's liquidity.
And do you think the Fed must know this? I mean, they know they're lying. They know what you know. What do you think the Fed's reaction is going to be? Is the Fed Reserve going to freak out and start, printing money full bore again?
Well, the Fed indeed has a pretty good sense of what's going on. And what's been at work here is that with the perception that the U.S. economy now is recovering, the Fed doesn't need to provide any more quantitative easing. The dollar has strengthened, as you've seen our major trading partners move towards quantitative easing because of the recessions they have. Well, guess what? We've got the same problems that our trading partners do. We're still in recession. They just give the numbers a little more honestly. We're not done with quantitative easing. The Fed still is, their balance sheet is the same. All they've done is they've stopped buying new Treasury instruments. But as it becomes clear that the U.S. economy, again, is still in recession, or is entering a new recession as it will be viewed, all of a sudden the speculation will come back that the Fed has to renew its quantitative easing or expand it. And where the lack of that new easing was a major factor behind the dollar's strength, any suggestion that the Fed is going to start easing again or expand its easing, which they'll have to do, will hit the dollar very hard. And as the dollar sells off, you're going to find oil prices spiking anew, inflation spiking anew, and eventually, as the rest of the world begins to dump the dollar, because the underlying fundamentals for the dollar just could not be worse. Fiscal conditions are not improved. The deficit numbers the last year were real small in headline form, but when you look at it using generally accepted accounting principles, still about $6 trillion. The U.S. still owes.
That's a year. That's in a year.
That's per year.
Oh.
Right now, the U.S. has, in terms of net present value, that's the cash you need in hand today to cover your future obligations. Total obligations of the federal government are close to $100 trillion. That's larger than the global GDP, something that's more 5-6 times the size of the U.S. GDP. There's just no way that the U.S. can handle that as things are structured. One of two things has to happen. Either the U.S. has to get its house in order, look to establish long-term fiscal solvency, to remove the threat of any sovereign solvency risk for the U.S. dollar.
That means cuts to everything.
Well, it means cut everything. It means also putting into fiscal balance the long-term programs such as Social Security and Medicare and Obamacare. Nobody's willing to touch that. But until they do, what remains open there is that the U.S. eventually just has to pay out the money for whatever it's obligated. It's not able to raise it otherwise. What it does is it creates money, it prints the money. And guess what? We saw a good trial run of that in the last year or so with the Fed's QE3. They were buying Treasury securities at a pace that accounted for basically 80% of the cash-based deficit of the federal government last year. They effectively not only funded that, but they monetized the debt. The Fed is holding those treasuries. The interest they earned on the treasuries they paid back to the federal government. That's monetization. That's what eventually gives you a hyperinflation. It was not extreme, but that's there. And you take that along with what's going to be a renewed decline in the dollar, and the decline in the dollar is the key to what happens going forward here in terms of inflation this year and the early stages of a hyperinflation. Right now, the dollar is strong. It's the strongest it's been in probably a decade. As the underlying reality of the economy hits hard, in conjunction with and confluence with the problems with the long-term solvency issues of the United States, in terms of the weakening economy, in terms of political disorder in Washington. All these factors come together. You're going to get very heavy selling pressure against the dollar.
And, I wondered, you've been talking about this, and it looks like there's two ugly ways for the dollar to blow. You've got this, you've said in the past, 16 trillion liquid dollar assets held outside the country. That's on one side. And then you have the government being forced to print, another QE4, another round of money printing. And then you have the deficit, which will explode. So you have really, those two big things, and plus an exploding debt. Is that how you get the hyperinflation that you were predicting in 14? You've moved back now to 15. I know it's a hard thing. It's a big thing. It's never happened quite like this before in America. But is that how you get the hyperinflation? Lots of money printing because we're in trouble. Lots of dollar selling because everybody knows we're in trouble. And the deficit explodes.
Yeah, all those factors indeed come together to give that to you. But the first stage of it will be a reversal in the dollar. We're not going to have a hyperinflation at this point until you see a massive decline in the dollar. That will start the process. Because with the, among other things, as you see the flight from the dollar, you'll see the repatriation of the dollars that you mentioned. The Fed's going to have to absorb that. And that'll start the trigger for the money supply growth within the system, which will exacerbate the inflationary problem and the deficit problem and the funding problem. So quantitative easing at that point will become an inflationary issue because it will be impacting the money supply and inflation directly, where the way it's been handled the last couple of years, it never entered the money supply. People who say, everything's fine again. Nonsense. You had a panic in 2008. The system was on the brink of collapse. People forget that. The system was on the brink of collapse. The Fed, the federal government did everything in their power to prevent it. They pushed things into the future, but they didn't do anything of substance to address the underlying problems. All they did was they pushed it into the future.
Are we going to have another panic?
Yeah. I mean, I think that's the type of thing that could break at any time. And you have the circumstance here where you just don't have the options you had back in 2008 for buying time from the future. The rest of the world gave the United States time to work things out. We haven't worked things out. The economy hasn't been turned around. The banking system is not operating normally. It's not fully solvent. If it were operating normally, you'd see normal bank lending. We're not seeing normal bank lending. If you look at lending to the consumer, and I'm talking, if you're looking at bank lending to our economy, normal bank lending, it's not there. Again, if you take the numbers out of the flow of funds from the Federal Reserve, you see the debt rising into debt outstanding rising into the recession, and then it falls, and then just flattens out. It's not picking up. If the money that the Fed created and went to the banks was again loaned out into the system, you'd see the money supply pick up. You'd see higher inflation. You'd see some pickup in economic activity. That never happened because the money was not intended to help spike the money supply significantly. It's not designed to help the economy. It's designed to provide liquidity to the banking system. That's still the problem. Those funds are still sitting there, but it's not moving into the economy. You still have the banking system in crisis. You've got the economy in crisis. The rest of the world's in crisis, but the United States is the center of it. That's it always has been. All the creativity here that got us into trouble came out of the geniuses in our system. We've had very smart people, very creative people and things got out of control.
Will they not be able to pull this out next time? I mean, next time it's going to be very painful, and they're not going to be able to do what they did the last time. I mean, we're going to have a financial calamity, the way it sounds by what you're saying, bigger than '08.
I think that's the way it's going to go. That's how it'll eventually play out. But the crux of it, and the thing to watch for is the dollar. You start to see heavy selling against the dollar, start selling off to below levels where it was back in June of last year. All the turning point in the dollar and oil prices centered around what was happening with Russia and Ukraine.
Do you think they were punishing them?
The U.S. It's the day the U.S. was seeking sanctions against the people running Russia. Within a day or two of that, you saw the peak in oil prices, the dollar turn. One way to kill the oil prices is to rally the dollar. This was an attack, a financial attack on the Russians, aimed at. I mean, we didn't take we didn't take open sanctions against the country, but we did put the financial pressure on by squeezing the oil prices. Now that's still not a stable situation. I don't know where that goes, but I do think oil prices have bottomed out, and I think you're probably close to a top in the dollar. As the dollar weakens, oil prices will climb again. You'll see the inflation pick up there, and as the inflation picks up, along with very heavy dollar selling, that will set the stage for the early part of leading into a hyperinflation. Because along with that, the rest of the world's going to start dumping the dollar, and getting into the crisis, I don't think the rest of the world's going to jump in here. There's been a lot of movement. People have been edging away from the dollar. Central banks have been buying gold. They all know what's coming.
They know that the dollar's going to get creamed.
Yep.
They do. You know that from your sources.
Yes, nobody wants to hold the dollar. I mean, you may have to for political purposes, but long term, the dollar, the dollar is insolvent. The country's insolvent. Yes, I mean, people tell me, nations don't become insolvent. Well, they certainly become the equivalent of it. And if you can't pay off, you don't have the funds to pay off what you owe, you just print the money. And you print the money, you debase the currency, you end up with a hyperinflation. So you end up paying off the debt, so you're solvent. The debt situation in dollars, you print the dollars. But the effect is the people that get paid off don't get anything of value. So I mean, it's just a matter of definition.
And if we have war, I mean, total chaos.
War, I mean, there are all sorts of things can happen there. I don't see war as a happy circumstance for the economy as you had back in World War II. Wars are generally terrible news, and the circumstances here are not ones that are likely to evolve in any way that would be good news for the U.S. or for the markets or for the global markets as a result.
Could this happen quickly? I mean, nobody's going to. I had a friend of mine tell me, "You'll tell me when it's going to blow up, right?" I said, "No, I don't know. I don't know that." I said, nobody's going to come out with a trumpet and go, hey, you need to, get, buy food and water and get gold and silver and put some tires in your car and all that. They're not going to do that. That's not going to happen. It's going to happen quickly.
How much warning did you have with the panic of 2008?
Well, you know what? I was at CNN back then, and all my sources, which you were one of them, and you were saying, this is going to be bad. We're going to this is going to blow up. The banks are all in trouble. I was saying that on the air at CNN. I said, my sources say the banks. You were one of them. And but when it happened, boom! Everybody went to bed on a Friday night and said, wow, things are beautiful. And on Monday morning, Lehman was insolvent. Was gone.
Yep. Well, that's how quickly it can break.
You think it's going to
it can happen with very little or no warning.
You think it's going to happen again just like that?
You may have, but in terms of the hyperinflation, you'll have some warning because you'll see movement in the currency beforehand. You'll begin to see some pickup in inflation beforehand, but the crisis that will bring that all about can happen overnight.
Boy. So you're saying that people should, hey, maybe you should stock up on some food and water and at least have some, because when this happens, isn't credit going to seize up? Isn't everybody going to run to the grocery store and buy everything in sight?
Yeah. Well, it's funny you say that. I don't mean to make light of such a thing. I was watching a show the other night with my wife on a potential terrible earthquake in the United States. And then you have this professor who's saying, okay, now, here we are, a minute after the shaking has stopped. He said, this is the time when people realize they should have gone out and bought water, and it's too late to go down to the grocery store to stock up on food. If you have a crisis ahead of you, the preparation, by definition, is something that you do before as opposed to trying to scramble out after. In terms of the inflation, holding physical gold and silver is a way of preserving the purchasing power of your wealth and assets, and that's over whatever difficult times are ahead. You get through the times, you still have the purchasing power of those assets you had, and it's liquid. But in terms of buying stores of goods to live on, canned goods, toilet paper, bottled water, the disruptions to the system here early on could be just as bad as an earthquake in terms of shutting down electricity so you can't pump gasoline, or getting distribution channels disrupted into grocery stores so that you can't get you want to hold some of that and reserve to cover a difficult time, just like I do out here in California, I'm not looking for, but anticipating a potential earthquake. What we're looking at here is a disaster just as bad in terms of the disruptive effects on people's lives, but it's man-made as opposed to a natural disaster.
And this is going to happen. I mean, this is not a maybe. It's just a matter of when, not a matter of if. Is that correct?
That's correct. And I think the odds are high you're going to see it this year. But first, the dollar's got to break. The dollar right now is strong. It's not going to happen with the dollar at its current levels. The dollar has to sell off. You'll see that. You'll have some warning on that. But watch what happens when the dollar sells off. Gold's going to be spiking. Oil prices are going to be rising. The precious metals you hold for the duration till you get through the end of the crisis.
John Williams, shadowstats.com. John Williams, thanks for coming on and giving us an in-depth interview about where we are in the economy and where we're going and your hyperinflation scenario. You're thinking 2015, maybe the year it starts, the hyperinflation, which is a process. But you're saying that 2015, maybe the year, is your odds-on favorite, that this is the year it starts.
I believe that's the case, and I thank you very much for having me, Greg.
Yes, sir. Thank you, John Williams, coming to us from California, shadowstats.com. John Williams, I'll put links to your site and your sign-up page. Thank you, sir, for coming on USAWatchdog.com.
My pleasure.